Good morning, good evening, good afternoon, whatever time it is and wherever you are. Hope you're having a great day. Rob McGregor here with our end of October 19 version of OnTrack, where we keep you updated with what's happening in the world and why it does or doesn't matter. Recording this on 26th of November. Quick general advice warning. This video is designed for clients of McGregor Wealth Management who are getting advice actively from us. If you stumble across this, by all means, enjoy it, but seek out advice before you act on anything contained here. What I'm going to cover today, as usual, is any important economic news, put that in context to what it's done for the market, look at the returns that we're seeing from the market, from the key markets that we're in, and put it all in perspective as to what it means to you and your portfolio. Not a lot of news. It was a funny month, kind of sideways a little bit. In the Australian market, we did see the Australian market go down a fraction, mainly driven by weaker bank profits and iron ore prices dropping, which of course drives BHP and Rio down a little. So the big companies, the banks and BHP and Rio are down. Lots of other companies up, but ended up being down overall. And news was dominated by the bushfires, and I'll talk more about that. Not that it means much for our portfolios, but it's an interesting insight into the media and modern reporting. The Aussie dollar's at about 68 cents. It's hovering at around 5-year lows, which has been good for exporters. It's good for our international investments. Not so good for you and I when we're travelling overseas, but it's generally probably where the Reserve Bank wants to see the dollar right now. Internationally, we saw slightly weaker growth numbers in China. We saw stronger growth numbers in the Eurozone, but they'd gladly swap those. When we say weaker numbers in China, they're in the 5s and 6%, whereas those stronger growth numbers in Europe at 1.2% growth instead of 1.1%, and pretty steady growth in the US. And the Fed, so much so that the Federal Reserve, the equivalent of our Reserve Bank, are now split about whether they ease again on interest rates or keep rates steady. There's a fair chance they'll keep rates steady, particularly as we do start that 1-year countdown to the US election, which will be held on Melbourne Cup Day in November this year. It's always struck me as a bit of a coincidence about why they have the election on Cup Day, but it is purely a coincidence, of course. They just have it in the first Tuesday of November every 4 years as well. So no real change to the continuing theme, which is we are in a low growth world. That also means that's also there partly because of low inflation. We've got low interest rates, and share markets are just climbing that wall of worry, providing us pretty good returns, but lower than we'd expect in higher growth times. But when we allow for inflation, the returns are pretty much as per normal. So let me get in further, and just a quick couple of reminders. Our care investment process, which most of you are in, is always built on the foundations of a personal plan, so the investments suit your plan, a deep understanding of history, which I talk about here often, understanding the behavioural traps driven by the way people mess it up, because we're human beings reacting to things, and then ultimately underpinning everything with smart investing. We put markets in context by using a framework called our wall of worry, where we know that the market goes through not in this order, but boom, bust, and wall of worry. At the moment, we're quite clearly in a wall of worry because people are worried all the time. You know you're in a boom when the market's doubled in the last 2 to 5 years, as it has done before every bust of more than 20% in Australia. So when we assess markets, we assess it on one of those bases. Now, we do know that most investors, not our good clients, because you're educated, aware and well advised, but most investors out there mess it up. We've seen that with all the statistics over the years, because they zig when they should zag when they should zig. That blows up over half their returns, and you can see that from the chart in the top right hand corner, which the green bars are the returns that investments got, being the S&P 500, the US share market, and the red bars being the returns that the average equity investor got. And that's because they mess it up, and the mess it up is just the letters that stand for some of these words. They're guided by the media. They're emotional creatures rather than logical. We tend to focus on short-term problems. At the moment, everything's China, US election. All these things go away. We have single issues, once again, that are combined with the short term. Now, there is only 3 ways to lose money, and one of those if you don't have cash set aside, and we always will have reserves for our retired clients to make sure they never have to sell at a bad time. The T for timing selection, we all think we can time markets, but absolutely nobody can. And under diversification, where we don't have enough diversification, and diversification, once again, is the bargain we make, where we bargain away the right to make a killing in return for never being killed, and focusing on performance. I'm going to talk about performance and the way statistics lie about performance today. I'm going to talk about media as my theme before I get into the market update. So this slide's headline, be careful where you get your information from, and too many of us get our information from the media. Here's a headline from The Guardian that says the media exaggerates negative news, the distortion has consequences. Yes, it does. So, and it goes on to say whether or not the world is really getting worse. The nature of news makes it think that it is. And in some research I did last year, which I'll be updating soon, 90% of people think the world is getting worse, when on every statistic, pretty much the world is getting better. So the media can be a disaster. I'll give you some examples. Now, I'm going to talk about the fires in this as an example. And every time we have fires and there's disaster, I'm not meaning to play down the personal nature for people where they lose houses, people, injuries, loss of life. These are serious things, and I'm not downplaying the consequences. But I do want to talk about how the media distorts things, particularly when they've got an axe to grind and they know they can throw fuel on the fire that is political debate. So here's a headline from CNN, 3 dead in unprecedented, in inverted commas, fires in Australian state of New South Wales. Now, I had to turn the radio off during the fires because I got sick of the word unprecedented being used. And to my knowledge, Australia's always had fires. Did a quick bit of research, and the 5 deadliest bushfires on record in Australia. We had Black Saturday in Victoria in February 2009, Wet Ash Wednesday in February, also in Victoria and South Australia in 1993. I remember that distinctly. My parents were out at a barbecue at a friend's place in the Dandenongs, and they ended up fighting fires in these people's backyard. And I remember that the ash that was over Melbourne was horrific. And look at some of the stats there. In that first one, 173 fatalities, loss of 2,000 homes. The second one, 75 people lost. The third one here was back in 1939, which was 71 people killed, 650 houses destroyed. The fourth one was in 1929. So we have always had fires. They're not unprecedented. Unprecedented means it's never happened before. But the amount of times we heard that word meant that people thought we've had the worst bushfires on track record, and they absolutely haven't been the worst bushfires on track record. So be very careful about the media and what you pay attention to. And this is an example from non-financial markets, but the media keeps people glued to their TVs. They love a good crisis, whether it be a market collapse, an economic downturn, or a natural disaster. And I'm not taking away from how serious these disasters can be. And anyone that was affected, my heart always goes out to them, but be careful on the media. Now, we see it in other areas. So, and I've titled this one, Lies, Lies and Statistics. Here's a headline back from July. And I picked July for a reason, which I'll talk about in a minute. But Australian stock market hits record high, beating level set before GFC. An ASX 200 share index back to pre-global financial crisis, but concerns grow about the strength of the Australian economy. Now, there's so much in that headline. One, there's the implication that just because we hit a record high, we're in dangerous territory. But then they say the market's back to pre-global financial crisis, but there's concerns about the economy, mixing them up as if they're the same thing. Now, the market is not the economy, and the economy is not the market. In the long term, they're related, but in the short term, they go their separate ways quite often. Now, let me get into these lies, lies and statistics. But here's a chart that goes back to, this is the Aussie market, the ASX 200, and you can see the peak, which was about 6,690 back in November, I think it was 2007. And we hit that in July, and we're hitting it about now. In fact, we've just gone above that. So this little performance chart here shows the 1 year return back in July, and it shows the 1 year return at 13%. Now, this shows the performance at the end of October, and the 1 year percentage return is 19%. Now, take note, they're pretty much the identical level. You'll see the dot where the end of October is, and the previous peak where, and if you can see my mouse here, they're the same level. So why is the performance now 19% when in July it was 13%, and yet nothing has happened? So in other words, we're looking at higher performance, but we know that the market hasn't moved that much in the last few months. So lies and statistics, here's why. So if we look at these two lines, so the line on the bottom shows the last 12 months return, and because we're measuring it from the bottom of a ditch, which is where the market was dropping towards the end of last year, and the market peaked in its drop in December, we're now looking at a steep increase. Whereas back in July when we hit that record, 1 year back, the market was much higher, so the performance didn't look as much. So even though you're going to see media headlines in the next few months, record year, because we've had returns of 20%, the fact is we've gone sideways for 6 months. Now, returns have been good, don't get me wrong. And you can see there to the end of October, we've had 5-year returns at about 8.4%, pretty much the same as what the 5-year returns were 6 months ago. So this washes out in the longer run. But be very careful about statistics about record highs and things like that. And I'll just point out that this is the longest it's ever taken to get back past the record. So it's the slowest recovery from a high that we've ever had in Australia. Now, none of that comes out in the media, so it's been a very slow pace. It's been a good one for investors who stuck with their long-term plans. But yeah, we're not at dangerous levels whatsoever. Quick update to the end of October, Aussie shares up, down for the month about 0.4%, but steady for the year. And as I said, we've gone sideways for the last 6 months, which is that top chart. But we can see the distinct gain we've had in the bottom chart. Long-term returns good, and we rate the Aussie market as just a little bit expensive. But the thing about the ratings at the moment is it's all based on what we think interest rates are doing. If we factored in the current low interest rates, i.e. 10-year government bonds of 1% into valuation models, shares would be dirt cheap. So we're still hesitant to do that. But we may see this start to happen in the next few years, which may see shares start to rise just on the back of being revalued if people think interest rates are going to stay lower for very long periods. Now, they won't stay low forever because markets cycle, and that's inevitable. But that is one of the dangers on the upside, is that we end up with higher share prices because we start to factor in permanently lower interest rates. So we think a little expensive, certainly not enough to be worried, and we think there's nothing else. As we said last month, what's the alternative? Cash and government bonds at 1%. So shares doing quite nicely in comparison. US shares much the same, down slightly for the month, but the 1 year return sitting at about 16.73. And while they all look healthy, the US share market has been running well. It's in that fair to expensive range as well. But also, given where interest rates are at, we're very comfortable with that. We don't see interest rates rising anytime soon, but we know they inevitably will, and that is the trillion-dollar question, is when they will rise, and nobody can tell you. There's nobody alive who's been through these exact conditions. The last time we had interest rates remotely this low was towards the end of the 1930s, and we had similar conditions. The economy is very sluggish. They couldn't quite get it to grow following the recovery from the boom of the 20s and the crash of the 30s and the depression. And the thing that eventually caused it to grow was a war. Now, we don't expect there to be a war. Certainly wars of different nature, and no war of that type is likely. We've got trade wars happening and other skirmishes, but you wouldn't expect in this day and age that sort of war. So it's going to be interesting to watch how we recover from this, and we think it'll be a slow and steady recovery, but watch this space, only time will tell. US small caps have had a fairly flat year, only about 6% growth, but they had a phenomenal few years before that, and we love them in the portfolio. It's smaller amounts for most people, but it is where the growth in the world comes from these emerging companies becoming bigger companies. Just a side note, that bottom slide there shows the fact that 21% out of the 80% return cumulative over the last 5 years for these has come from the fall in the Aussie dollar. So that's good for investors. There's probably not a lot left in that fall, potentially. So that means we don't expect that sort of free kick from international shares for the next little while. Having said that, we still do view them as a very important part of the portfolio. Global leaders, this is the top 100 companies in the world which form part of our core portfolios. Same thing, they've had a free kick of about a third of the return in this case from the falling Aussie dollar, and good solid returns, a quiet month but a solid year, and continuing to deliver, and we also view them as fair to expensive. Emerging markets we still view as cheap. They've been battered around by the trade wars, and you'll see the top chart which shows the last 6 months. Much more volatile than the Aussie shares. The Aussie shares have actually had the lowest volatility year for a long time. In other words, they've just been going up steadily without any big dips, not since last Christmas. But emerging markets have had some big dips, including at the start of the trade war and other factors. Looks like there'll be a phase 1 resolution, as they're calling it, which is really Trump wanting to have some sort of agreement in place before he contests the election. We'll see we'll know whether China wants Trump to win or doesn't want Trump to win by whether they make that easy for him or hard for him. It's going to be fascinating to watch. Either way, it's still acting as a slight handbrake on the global economy, and it does affect emerging markets more than developed markets, but nothing to worry about, and certainly nothing to distort the way we're managing the portfolios. Gold had that incredible spike from the start of May up. Gold is perfect insurance for a portfolio. It doesn't produce any income, so it's only worth a small part of the portfolio. It hadn't done much for the previous 10 years, but it certainly spiked in the last year, although it's been pretty quiet now for the last 3 months. It's trending down slowly, and that's because we haven't had any major shocks of negative announcements. Nothing guaranteed more than at some stage in the next year we'll have something that surprises us, that causes a market downturn, and as nearly always the case, there won't be any need for panic, and no doubt gold will spike up at that time. Performance for the portfolios is continuing to be rock solid. Pretty quiet for the month. They were slightly down or slightly up, but when you look at the longer term performance, particularly across the 1, 3 and 5 years, all the portfolios are delivering above their benchmarks. They're also consistently delivering above the average for their peers. In fact, they're sitting in the top quartile, with some of them sitting in the top 10% of comparative funds, and doing so because they're simple, cost-effective, smart asset allocation, and the occasional but infrequent strategic decision to adjust some of those things slightly. But we don't mess with it a lot. We're not reactive, and that proves itself in these good solid numbers, which enables us to plan for your future. Never complacently, so always on the alert, but yeah, very pleasing, these numbers. So property markets, fascinating. Sydney and Melbourne have had a recovery, up again for the month, to the point where Sydney houses, Sydney units, so Melbourne units are now up even over the last year. They've had a bit of a bump up, but the numbers are starting to stabilise, and monthly pretty much everywhere. Perth's still down a bit. Darwin's had a shocking time the last year. We can see there, sort of 9% downturn over the year, and units 7%, so not much fun for property investors in Darwin. And I know we've got a few clients from Darwin who are feeling that pinch. The markets will cycle, but it's looking like a long struggle out for Darwin. And for those buying property, we're probably very comfortable in Brisbane / Southeast Queensland, including the Sunshine Coast, and potentially Perth, but also Sydney and Melbourne for very selected areas, starting to look like a bit of stability, although probably won't have the growth of the last 10 years for a while. The Property Clock, Aaron Todd White, which you can find this full report online, and if you're into property, it's worth a download every month. It's not the gospel, but it gives you an interesting picture of where they think the different property markets are around Australia, and that is just a good reminder that there is no one property market, there are multiple. The interesting one for me is they put Sunshine Coast at the peak of the market. I don't actually agree with that, but I respect their opinion. And I think I sent out to most of you a report on the infrastructure on the Sunshine Coast. And I think we're starting to see, and I'm hearing from clients, that there's interest coming into some of our markets, particularly the Noosa market, from people in Sydney and Melbourne now that their markets have bottomed. and quite clearly recovering. So some interesting stuff there. They've got Sydney and Melbourne now at the start of the recovery at about 7 o'clock. There was a good report out from SQM Research which talked about Sydney and Melbourne probably having a good year, but that likely to be subdued over the next 5 years. Now, given most people, so for some with property in Sydney and Melbourne, it's not a bad time to get out if they needed to get out. But if you're looking for growth over the next 5 to 10, we may see some of the other states slightly more growth. Sydney and Melbourne, of course, are blue chip. They will do well over the long run. Assuming, as always, the population of Australia keeps growing, which is the big assumption for property markets. Units similar, and you will get the hard copy with this report. So feel free to have a look at that or download. So putting it all in perspective, not much has changed from last month. Thanks for listening through. Hopefully a couple of new insights. But what the current conditions mean is pretty much steady as she goes. Stick with the plan. It's not a bad time to be buying or selling. For those with big amounts of new cash, we're averaging that in over a year. We're putting about a third in up front, averaging over a year. For those that need money out of the market, we're happy to take it out of the market. So it's in that in between. Yes, potentially going to be better times for buying or selling. I do expect that we'll get some dips next year. They're kind of inevitable. We've had virtually none this year, which is very, very unusual. We normally would average a dip in the 5 to 10% range, and we haven't seen one since last November, December. So I'd expect some volatility next year. And as always, there may be better times to suit if markets get a little expensive. There may be better times to sell if markets get a little expensive. And as always, we like to average in new money and wait. And for our accumulators, it's a great time, as always, to be dollar cost averaging. And we'll review as we sit down with you, or if things go remarkably out of whack, which we don't expect. So just to reinforce the process, goals first, based on who and what's important to you. Portfolio designed to meet your goals. We take a long-term view, which is really important. It minimises the noise, minimises the fuss, and keeps us on track, and it works. Then, because we're doing all that stuff, we can focus on the important things: massive diversification, the right asset allocation and liquidity, and low-cost index for most gross markets. And ultimately, protect against that short-term volatility with reserves for our retired clients and dollar-cost averaging for our accumulator clients, and rebalancing regularly. So, hope you enjoyed this month. Apologies for it being slightly late. It's been an incredibly busy month as in the run-up to Christmas starting already. I will get one more report out before Christmas, so I won't wish you all a Merry Christmas yet, but I wish you a good run-up to Christmas and hope you have a great month. Rob McGregor signing off for this month's On Track.